येष सुप्तेषु जाग्रति येष सुप्तेषु जाग्रति कामं 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 कामोक्षो मोक्षो निर्विमानः तदेव शुक्रं तद्ब्रह्म तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्ययितश्चन एतद्वैता 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 एतद्वैता.
So first topic today, it is going to be on recent technical and regulatory developments impacting audit. So all the new acts which are going to impact our audit, labor law code. So there are some changes which everyone needs to ensure that we can keep those particular part in our audit report. So it is going to be taken by a learned speaker, CA Samir Parmar. So I would request Sandeep Bhai to please briefly introduce today's first speaker of the session. Thank you.
Good morning, friends. Welcome. Samir Parmar is a chartered accountant and a member of the Institute of Chartered Accountants of India, Bachelor in Commerce from the Institute of Mumbai, and Diploma holder in the Information Systems Audit course from the ICAI. Samir Parmar is a partner in the India Insurance Practice at KNAV and is based out of Mumbai office. Samir has a rich experience of 20 plus years in the field of audit and assurance services. Having worked in a reputed audit firms in Mumbai, he has gained a rich knowledge and specialized in the statutory audit, tax audit, financials and auditing, due diligence and management audit. He also has the experience of a hand-holding of the startup companies and was a part of a special assignment such as preparing the companies for the due diligence and positive investment review, etc. Samir has also contributed and co-authored several articles on various topics in journals and the online platforms. Samir's clients has included various Indian companies and multinational companies and the listed companies. Samir is also a core committee member of the Bombay Chartered Accountants Society. So please welcome Samir Parmar and take it over. I request Pratik Mare to give a memento to the Samir Parmar. And the benevolent fund receipt. Please give a round of applause. Over to Mr. Samir, sir.
Thank you. Very good morning and thank you Borivali Study Center for inviting me again. It's a pleasure to be presenting here for the third time in a year, and I will try my best to share my knowledge in terms of whatever we do in terms of audit. So what we have tried to cover here in this topic is whatever are the recent amendments, especially with respect to the labor code. There are a few amendments in the Ind AS also, mainly on the disclosure part. Nothing much on the recognition measurement, but those disclosures are also very important to be noted. There are few things which I am going to cover with respect to the NFRA. So NFRA you would have read in the newspaper, and a lot of reports they issue in a year based on their review of the the company's financial statements or the audit quality of the firms. So in current year there are two circulars, out of which I am covering one, which is very relevant from the audit procedures and audit documentation perspective. Then there are FRRB and the QRB observations. So there are reports which have been issued by FRRB and QRB. So it's a big report, and I try to cover which are the common and in general the points which are getting missed out for your reference, and we can have a discussion on that. You can stop me wherever you feel, and if you have any questions, feel free to ask in between, not necessary to ask at the end. It will help to make it as an interactive session. So the new labor code, I'm sure you would have read a lot on this. I'm not covering the labor code as such because I'm not a labor consultant expert. What I've tried to cover is the impact on gratuity and the leave provision, which will have a financial implication because of this new labor code. And there are a lot of things which are there other than gratuity and leave. But gratuity and leave are the most important and financial element when you look at from the financial statements perspective. So these are the background. So there are basically 4 labor laws now. Labor codes, basically the Code on Wages 2019, which subsumes 4 laws. Code on Social Security 2020, which subsumes 9 laws. Occupational Safety Health Working Condition Code 2020, which subsumes 13 laws, and Industrial Relation Code 2020, which subsumes 3 laws. So basically there are 29 existing labor laws which got subsumed into these 4 labor codes now. Out of this, the most important from the audit financial implication perspective is the Code on Social Security 2020. So this was introduced in 2020. But it got notified in current financial year, this is 25-26, effective 21st November. These are all applicable, and all the financial reporting period after 21st November must have these financial implications of this new labor code. So there are a lot of procedural things so that we are not covering. This is a summary of what consists of the Social Security Code. So there are 9 laws which have been subsumed, including PAF, SIC, Gratuity Act, and etc. All these are few laws. So coming back to the main subject in terms of financial implications, so there are key definitions. There are a lot of definitions which have been covered, like employer, employee, wages. So most important definition to understand from the audit perspective is the definition of wages. I'm again repeating that I'm doing only covering only the gratuity leave part, so I'm not even referring this from that perspective only. So till now, what we used to provide for gratuity was on the basic salary, right? And the leave also, a lot of company had encashment and availment portion, where some companies used to pay leave on the basic salary, and some companies used to pay leave on the gross salary, and then there is a availment portion which comes in the picture. So now what change is going to happen, and this will be the most common area for all the audits this year, because every company has with a gratuity leave provision in their books, and the way the calculation happens and the way the data which is going to be sent to the actuary is going to change. Okay, so you have to be, as an auditor, have to be very it's a crucial and critical area for this year's audit. So when it comes to the definition of wages, what it covers is basic pay, DNS allowance, retaining allowance. So this is a simple basic wages definition. And they've now said what it excludes. So wages does not include this A to K, which are present on the screen. So these elements are not considered as wages. These are the exclusions from the definition of wages. So they've made it clear what will be included in wages and what will be excluded from the wages. And now the main part comes, which is the ceiling rule. So what it says, so when you do a gratuity calculation, it will not happen only on the basic wages. If your allowances exceed the 50% of the total remuneration, that excess amount of allowances will also be part of your basic wages, and what will happen because of that is your base salary will increase, which was earlier considered for gratuity provision is not going to be the same figure. So I will explain you by way of example also, which is there in the subsequent slide. So the major and common thing which company used to do, they used to keep the basic element at lower base. So some company used to have 20%, 30% as the total CTC, as a percentage of the total CTC. Sorry. It's 3 4. So generally, company used to keep the basic element of the CTC very low. What used to happen because of that, your PF, ESIC, your gratuity and leave outflow because of that lower basic element. That used to be like saving for the company because they do spend out less money, and that is how they used to structure the CTC. So the basic objective was to keep the basic low. So that's what the government has tried to plug that loophole. So they are not asking you to increase the basic salary, but at the same time they have defined in such a way that if you structure the salary in such a way that keep the basic at a lower portion and keep the allowances as a higher portion of in the CTC. So they have defined that limit of 50%. I'll explain you with the example, that will be easier. And if there is any remuneration in kind, then 15%, so that's also considered as part of your allowance and part of the salary while calculating your salary. This is the one new thing which has come up in Social Security Code. So till now, our understanding was that the employee who completes the 5-year gets the gratuity. Now even the fixed term employee also gets the gratuity. So fixed term employee is an employee which is not on payroll. They are on a contract basis. So they are hired only for a specific engagement or a project. And their contract period is like 1 year, 2 year, 3 year. So they are not on a payroll. They are not full-time employees of the companies. So they have also been now covered in the code, and they will get that gratuity if they complete the 1 year of service. So if the contract with FT is more than 1 year, then gratuity is payable to them on completion of their contract. Yeah, so this is the example. So if you look at the example, so break up basic plus DA is 30,000, other allowance HRA bonus extra is 70,000. So what you can see is, if I take the 1 lakh is the total remuneration, the basic consists of 30%. Okay, so that is how the structure basic salary is structured. And as per the revised rule, so you have to calculate the maximum exclusions allowed. So that is 50,000 and 70,000 minus 50,000. So that total allowance of 70,000 and 50% of 1 lakh, which is 50,000, and balance 20,000 will be added to your basic salary, and that is how your gratuity calculation will get revised. So your base for gratuity provision is now going to change. So earlier it was only 30,000, which was basic plus DA. Now you will have to also add that 20,000, which is in excess of 50% of the total CTC as part of your base for gratuity calculation. And that's how for all the audits, all the clients where their basic is less than 50%, the gratuity provision is going to get increased for this year. And if you have any questions, please feel free to ask, because this is a very important concept.
So if something is received in kind
Yes.
and leasing is not doing till 50%,
Right.
so then that kind portion only will be added, so not other way, right?
No, so basically you have to see what is the total remuneration, including in kind. So total remuneration which is paid in cash and in kind, you have to total it up. And out of that 50% should be considered for the gratuity valuation purpose. So that's what this concept is important because till now to actually we used to send the data of only basic salary. We never used to give the other allowances or the other payments which are going to the employees. So you have to be very careful while evaluating the data which is going to actually because the other things are also going to be considered because if you end up giving a wrong data of total remuneration, your gratuity provision will be understated. Okay, so many companies do that kind of structuring which is not part of CTC but they still pay separately, like variable bonus which is not part of your employment contract, but and there are companies who are already started thinking in terms of how to get out of this exclusions and structure the salary in such way that the gratuity provision is not increased. Yeah. Sorry, I'm not able to hear. So yes, so depends. So if you have a contract for 1 year, 2 year, they will be part of that. So it doesn't have, there is no age barrier. So the moment you have a contract for a particular number of years for a specific project, they will have to be paid gratuity. Yes. So most of the time FTEs are part of the professional base as treated as a consultant. And in fact, there is other concept of gig workers, which are actually not having a contract also. So gig workers are also going to be covered in the gratuity and other employee benefits. The rules are not notified yet, but so basically they want to expand the coverage. So every person who is working for a company, unless they are actually a consultant, they will be covered for the gratuity purpose.
And what about, sir, the workers employed through a contractor? Whose liability? Is it as a principal employer, the company has to provide, or the contractor?
So for right now, gratuity purpose, that's not clear. That's not directly coming out of the reading. So unlike PF and ESIC where the principal employer is responsible, but currently it's not there in case of gratuity. So if you have a contractor who supplies the manpower, you don't have to calculate gratuity for those people. But let's say if you there are companies who pay as a part of the customary practice, the way they pay all employee benefits to their employees. There are many companies who pay all the employee benefits to the contractor employees also.
Yeah.
So if that is a practice, even the previous accounting standards made it compulsory to make a provision for them also. So if that's the case, that continues. There is no change in that. So if the company's policy is that they are paying gratuity or leave benefits to all the employees, including the contract employees, so there is no change there. So only the way of calculation would change. Because the earlier calculation was only the basic salary, now we will have to see the allowance part also getting covered.
And what about the variable component, which is paid maybe on the percentage of sales or so?
Yes.
Whether
Yes.
there's little bit
Yeah.
of
So that's why
clarity
this definition becomes important. So you'll have to see and assess whether you are part of the excluded component. So these allowances which are there. These are the allowances which they have prescribed. So if these are excluded allowances, if you are paying anything out of this, then that gets added. So that's what I mentioned that people have already started thinking in terms of how do we get out of this definition and still pay to the employee, not cover it for the gratuity.
Thank you, sir.
And this is relevant for us as a consultant and a firm also because we also have our employees. So their CTC structure also may have to be relooked because that will increase the outflow for you also in that sense.
Paid by way of bonus?
Yeah, so anything paid under the employment contract as a part of their remuneration will have to be added up and calculate the total remuneration. So irrespective of how you are paying, what nature of...
No, wages exclude.
Yeah, so that's the statutory bonus. So under payment of bonus act, you never make it part of as a CTC. So your appointment letter doesn't give that breakup as a one of the element of the CTC because it's statutorily payable. So that is what it refers. So when it says bonus not forming part of the employment term, because why? Because it's payable as under the statute.
So it covers only 8.33.
Yeah.
Thank you.
Yeah.
So when we talk about the applicability of new labor law, it is applicable from November 25.
Yes.
However, there are few of the state governments which have not yet accepted it, or maybe there are rules which has not yet been notified. So how are we going to account all those things? Because gig laborers, your overheads and everything should be approved by a state government.
Yes. So basically for, that was the next slide. So PF and ESIC still continues as was earlier because state governments and central government still not notified a lot of elements out of this like minimum wages or the threshold of 15,000, 21,000. In case of ESIC, PF is 15,000. So that is how this is still in abeyance in that sense. So there is no impact currently on PF and ESIC. But for gratuity, it's immediately effective from 21st November. Yeah, agreed. So there are a lot of other components also, so like gig workers and other employees who are part of, who will be part of the code. This will increase. So if you see the lot of quarterly results which have come in December, they have put a note that there is an impact on account of the social security code and companies continuously evaluating and monitoring the changes which are happening. So in March accounts also you will see a lot of such additional impact which will come.
So sir, you mean to say in the financials there will be upcoming impact of gratuity also?
Gratuities for sure, depending on how their salary is structured. So the companies who have already have this 50% as the basic of total CTC may not have that impact because that indirectly complies with this requirement. But unless you assess that total remuneration figure and then derive that 50% is something which is critical. Because only having a 50% of total CTC as per the company's understanding may not be the right way in which this compliance is required. So as an auditor, you will have to ask all the payments which are going to the employees, whether by way of contractual agreement or otherwise. You have to then assess whether this will form part of the wages definition or part of excluded allowances. Total it and then see 50% is matching with the basic figure, basic salary figure.
And sir, one more question with respect to FTE employees.
Yeah.
So it is basically you should have a contract even if you don't have it for 1 year or for the multiple years.
Yes.
But the company will going to account it as a contractor, not as an employee. So 194C
So
maybe.
accounting is not going to be a relevant factor when you assess this code. So the moment you have a fixed term employee, obviously they are called FTEs because they are not on payroll and they have a limited period of tenure. So it doesn't matter how you account, where you group, whether it's part of employee benefit or a professional salary, professional consultants. So it doesn't make any difference. So accounting is not a relevant thing. So basically you have to see whether they fit into the employee definition.
But for then employee definition, we need to have a proper employee-employer relationship in it.
Yes.
So in case, say for an example, there is one person who is providing some financial related services only for a 1 year. So will it come into a definition of a FTE or will it just a contractor or technical service we can say?
Yeah, so again these
So
are all...
how to define
so it's going to be a challenge. That's why I'm saying. So as an auditor, we have to see maybe opinion from the labor consultant will be very important. How they are structuring this part and what are the terms and conditions which they are mentioning. As I said, I'm not an expert in labor law, so which element of the clause or the terms and condition will make them out of this FTE definition. is something which is very, very crucial. So that's something which needs to be evaluated on case-to-case basis.
Thank you so much.
Yeah, thank you. So partners are not employees, so there is no impact there. But directors are employees. So in a private company, directors are treated as employees. An earlier law also and here also they are employees. So whatever remuneration goes to them, 50% of that similar calculation what we do for employee will happen for them also. So there is no change as compared to the earlier law. So whatever employee benefits you are giving to employee and the director are at the same level, and you have to consider it for gratuity, leave, or any other employee benefit.
Years.
No, so gratuity comes in the picture only if completes 1 year. But there are other employee benefit like PF, ESIC, so that's where all these rules are pending to be notified. So even if it works for a day, so there is one definition which I think 30 days is something which is a cutoff. So any person who has worked for 30 days during the year is entitled to a lot of benefits under the code.
The 30 days is a continuous service or a casual service?
No, so that I will not be able to answer what exactly conditional service means. So that's something again labor law can advise, the consultant can advise.
Thank you.
Contractor is taking care of that PF and ESIS then?
Yes. So there is no change in that arrangement. So only the thing is currently as of date we have clarity on gratuity and the leave and the wages calculation which will be happening. PF is still not clear. They have still not been notified. So even I don't have much information on that. Yes, sir.
Sir, I have a case where majority of the people are paid through the check for decades, but they have not been given the appointment letters. And same amount, sir. Huh? The beauty is that the number does not change. It changes same number for decades. And no gratuity, no PF, no ESIC, nothing. So you are falling under the category of consultant. But because of these amendments, it looks like now this gratuity and all these kind of things will invoke.
Yes.
Thank you, sir.
Yeah, so that's what the government's intention is, to increase the coverage, not only to the employees, but everybody who is working for the company, whether they are on fixed term contract or they are gig workers. So basically they are looking at them to give all the benefits which employee gets.
In many hospitals, doctors are working full time, but
Yes.
they are paid professional fees.
See, this arrangement is there. A lot of companies we see that. So income tax department sometimes take a view that they are not a consultant and TDS should apply as a normal employee. TDS should be applied. But the important thing here is to note that again the definition of employee. And we still have to evaluate in terms of whether those people will be part of the definition, and if they fall under the FTE definition, they will have to be considered for the compliance purposes. So I understand, so a lot of companies have the consultant, so it's not only the hospital. In a normal company also they appoint a full-time person but as a consultant. So they are paid, actually they are employees,
Yeah.
but to save TDS or to have income tax benefits, they are given the consultant agreement. So maybe we'll have to, that arrangement will have to be reconsidered considering this law. There is no clear answer right now. But I agree, there is such an arrangement which is still going on.
So in case of labor contract where the company has hired a contractor, but his people will keep changing.
Yes.
They may be there for 1 year, or they may not be there for 1 year, or there are some workers who may be continuing for more than a year. Then in that case, how this bifurcation will?
So
We have to.
So I won't be able to answer. As I said, I'm not an expert on labor law consultant. So something is which is basic in terms of calculation for gratuity leave, something which I can answer. But yeah, these are all a lot of practical questions. Practical difficulties are going to be there, and this is just a beginning. There is no clarity. There is no clear guidance available. ICAI has issued a guidance note which covers only the gratuity element. It doesn't talk about any other arrangement or any contracts, how they will be covered. There is a FAQ on the Labor Law Ministry website also, but doesn't talk about all this practical way out which people have done so for so many years and how those will change.
Okay, thank you, sir.
How
Yes.
do I control my outflow so I'll not pay gratuity? Okay, make him consultant. I'll not pay him PF, so I make him consultant. I'll not pay ESIC, make him consultant.
Correct.
This is, see, the basic idea is not the one which is the TDS, but the whole idea is that how do I control my outflow? Where do I block the PF, ESIC,
But that's what
gratuity?
government doesn't want you to do. So government wants the extended coverage and pay to that person what he is eligible for. So for so many years, many arrangements have taken place in a different way. As he mentioned that it's a full-time person working as a consultant on a paper. Yeah, but that's something which is should change now with this implementation. Maybe that's why it has taken so many years to come to the light. So let's see. Yeah.
What all category should be there for an employee to be considered as an FT?
No, there is no kind of
So
nature
they
of
have
work.
not defined the term FT itself, and they have bring this
Yeah.
word.
Yeah. Right. So I'll move ahead. So the accounting part, the moment you have assessed the definition and given the data to the actuary, once the actuary comes back, generally what you used to see in the notes to the accounts when it comes to the employee benefit, you have a P&L breakup in terms of current service cost, interest cost, actual gain loss. This year we will also have the past service cost as one of the line item, because what will happen is because of the tenure of the employee, depending on how many years they have served, you will have a additional impact on account of previous years. So let's say if some employee has completed 10 years, so his 10 years gratuity will get recalculated with the new definition. Okay, so there will be impact depending on how many years of service an employee has completed. So that's why this past service cost will be there for accounting purposes and for disclosure purposes for this financial year. So basically we have covered two scenarios where the change happens only because of this labor code and normal increments which happen. So in scenario one, the complete figure will go to as a past service cost in the P&L and the notes to accounts. And if there are normal increments also which are happening because of which the gratuity provision has increased, so basically you'll have to break up the total provision into two elements, one because of the change in the financial assumptions or increment, and the other because of the social security code. So you have to be aware of these two segregations. Generally actually evaluation will have this breakup, but if it's not there, you should ask the actuary to give that breakup separately, because otherwise everything goes as a past service cost. So the moment it fits into FTE definition, if you have a fixed term contract, I don't think it will have any impact how many companies is working for. So that's why this labor consultants will be very important person to have an association or collaboration with, to ask all queries regarding this particular things, whether they will be FTEs or not, or they will be purely a consultant. It's going to be a difficult drafting of the consultant agreement. Yeah. Right. Yes, agreed. So under both the standards, so, we have currently previous gap and the Ind AS. So the even past service cost has a different accounting treatment. So under Ind AS, full amount of past service cost will be debited to P&L So your P&L for the year will have a significant impact under Ind AS. Whereas under the previous gap, you have two breakups, wasted and non-wasted. So let's say, what is non-wasted? The employee who has not completed 5 years of services. So any past service cost related to that employee can be amortized over the remaining service period. So let's say if employees join and it's a first year of service, his past service cost will be amortized over 5 years. So it will not give you a full impact in the year one. Whereas if some employee has completed 5 years, the full charge will come in the year of change. So that's also important when it comes to the gap differences. So if you are doing audit for the previous gap, you will have to be very careful in terms of this bifurcation of wasted and non-wasted employees. So there is no restriction. You can have a full charge in the P&L instead of doing amortization depending on the materiality. But that option is available for non-vested employees. Yeah. Yes. So that's why that FTE will come in the picture. So if your employment contract is for 3 years, the moment he completes 1 year, he will be entitled to gratuity. No, it will be charged to P&L, not part of OCI. It is not considered as actual gain loss. It's actually element of current service cost for all the previous years of services which he has rendered. So that's why this bifurcation is important. So if you have a normal revision in the financial assumptions, let's say salary increment was considered 6%, you change to 8%. So that impact is actual gain loss, and the remaining will be past service cost. Yeah, so this is example of what I explained in terms of past service costs. So under Ind AS, it will be the impact in year one, and under the IGAP, there will be a split between a vested and non-vested condition. And if it is because of scenario 2, which I explained, because of the change in financial assumption under AS 15, it's part of the gratuity, and under Ind AS, it goes to the actual gain loss. So leave benefit technically is not covered under the code, so it doesn't have to comply with this labor law, labor code definition. So only the contracts which says the salary at which the encashment will be done will be as per the labor code, then only you will have an impact under the leave calculation. Okay, because otherwise the management policy will override the code. So let's say if many companies have defined that leave encashment will happen at the basic salary, there is no change because of the code. So you have to read that policy properly. The encashment portion is at basic, or they have covered the labor law definition as the element at which the leave encashment is going to be paid. So where the structure is changed to comply with the labor code from 30% to 50%, then the leave impact will come. Otherwise, let's say if they continue at 30% and the policy says that leave encashment will be at the basic salary, there is no impact on account of leave provision. So you'll have to see if there is a structure which is changing in terms of salary, and then only assess the leave impact for the leave encashment purposes. So in both scenarios, there is an impact because of the change in the structure, and the other is on account of change in salary. So under leave, there is no option under the both gaps, as we discussed in the gratuity, vested and non-vested. So this I've already covered that post 21st November, any financial statements which are prepared will have the impact of gratuity and leave as applicable. We have tried to cover this particular practical problem. This is not part of the ICAI guidance note. So basically the common question which will come is on the inventory valuation, because your employee benefit cost is going to be larger. So in case of a manufacturing company, you will have a bigger cost of employee benefit. So you have to be careful when you do the assessment of the overheads which are loaded on the inventory valuation. So you should exclude the past service cost. Sorry, because otherwise your inventory valuation will be overstated, because this is not current year's cost. So when it cannot be linked to your manufacturing activity for the year, because it's a past service cost. You cannot load that on the inventory valuation for current year. This is our view. This has not been clarified anywhere, but this is one thing which came during our audit, and that's why I thought of sharing with you. Disclosure perspective, we talked about the accounting on gratuity and leave. So many companies are disclosing this particular charge as an exceptional item. But again, this is not by default. Under Ind AS, there is no definition of exceptional item. It has to be assessed on case-to-case basis. Okay, so it has to be a material item at the first place. And you have to see from the overall perspective of the P&L account in terms of revenue, size of revenue, and the profitability. Not every past service cost of this labor code will get accounted as exceptional item. So it depends on case-to-case basis. But in general, December quarter results, if you see, many companies have taken this view. I'm not sure whether it was based on the materiality perspective, but in your case, you'll have to see whether actually it needs a disclosure, because not every company may have an impact, significant impact in their P&L. This is just a screenshot of the presentation from the December's limited review. So if you can see, there's a statutory impact of new labor code, which is shown separately as under the exceptional item, and there is a note below which explains why this charge has come. And company, if you see the last 2-3 lines, it says that company is monitoring the impact because of the pending notifications of various notifications or the rules which are yet to be notified. So the additional impact may come. So if you see the quarterly results, you will see these kind of disclosures in many companies. And similarly for year end also, you can have this wordings or the draft notes. So we'll come to the NFRA circular on communication with TCWG. So again, when we do the audit, generally, I'm sure most of the times you would be dealing with the accountant or the CFO. The data is shared with you, you complete the audit, and it's given to the directors at the end for signature. And most of the times you don't meet the directors. Right, the audit is completed at the level of the accountant or the CFO, and you don't know who is the director, and you never met them. Okay, so this is nothing new. This requirement to communicate with TCWG has been there for many years. There is a standard on auditing 260 and 265, which made you speak to the TCWG with respect to all the elements of the audit. So from the planning stage to the completion stage, you have to communicate with TCWG. And what was happening since last 2-3 years, there was a report by NFRA which said that its auditors are, the non-compliance was on account of auditor did not communicate with the TCWG. But if you read the standard, there's a requirement of two-way communication. So auditor alone cannot be held responsible if the communication is happening from his side, and there is nobody at the company's end to discuss with, right? So that is where NFRA has come up with this circular. There is nothing new which has been specified here, but it only makes clear that both the parties, the auditor and auditee, are responsible for complying with this requirement. Governed by the auditing standards, okay, to do perform his responsibilities in terms of audit procedures. It cannot be only the auditor who will be responsible if there is no communication which is happening. So this particular circular only emphasizes on the responsibility at the both end. Even board of director and the audit committee both are responsible for compliance and communication purposes. And they've given basically 5 elements which are very important when you communicate with the TCWG. So when you start the audit, you must identify who is the TCWG. So TCWG's full form is those charged with governance. So it cannot be an accountant, okay? It cannot be a CFO. So in a private company, it has to be the board of directors, okay? So it cannot, you cannot have only communication. You may have a routine communication with the accounts team, but when it comes to the compliance, the communication with respect to the audit, planning, scoping, important issues like of internal controls, deficiency in controls. So all those has to go to the board of directors in private company. In a listed company, there is audit committee. So what it says, generally the board of directors are the TCWG, but in listed companies and other public companies, you have audit committees. So those can also be a subgroup with which communication can happen. So it's very important to identify who is your TCWG and make the communication to them accordingly. So the next element is the determination of documentation. So it has basically when you plan the audit, it's only your audit team knows how the audit is happening, okay? So what areas are going to be covered, which are the key areas. But that communication has to be told to the TCWG that, okay, this year labor code is going to be the key areas, critical area, which I am going to audit. And let's have a meeting for that. Okay, so you must address it to the TCWG, whether it's audit committee or to the board, and ask for a meeting in terms of communicating that key area which you have identified. And you can also tell them if they have any points which we should cover as an auditor, is also an important communication parameter when it comes to the determination of the documentation. So an appropriate form of communication is also important. So most of the times you have a verbal communication, so that's also allowed. But then you must have a minutes prepared that who all were there in the TCWG. It's sleeping. Sorry. Yeah. So that depends if he has been given the authority by the board to act like that, so then it can be possible. But if he's not a director, then you may want to still address to the director that so and so communication has happened with the CEO, and this is for your information. Sorry? Yeah. Yeah, correct. So if it's part of the board, then you can, so that's what, again, that's part of communication. So you can, in the beginning, you can communicate to the board that this is the TCWG which I have identified. If you are if you are on same page, then I'll continue that discussion with them. Let's say if some director comes back and says, no, we also want to be part of that communication, then you'll have to change that. So basically, whatever identification you have made in terms of who is the TCWG, that also has to be communicated that I've identified this group or this person as TCWG, and I will communicate every aspect from the standards requirement, and accordingly that communication will continue. Yeah, so as I said, there has to be minutes of the meeting. If there is a verbal discussion which is happening, telephonic discussion which is happening, but preferably you should ask for an in-person meeting at least once in a year. You should know who are your directors or the promoters of the company, because doing only audit with accountant and CFO is not the right way of doing the audit. Timely communication is also very important. What it says, if you make a presentation on the date of the audit committee meeting is not appropriate, because you are not giving enough time to the audit committee to go through that observation. Yeah, anyway, it's okay, I'll manage. So basically it says that if you make a presentation on the last date, which is the date of declaration of the result, there is no in which the audit committee can give you any points for further checking or some deliberation. There is no time available, because within the completion, after the completion of the audit meeting, immediately there's a board meeting and you have to declare the results. Okay. So timely communication means that you give advance intimation to them, you circulate your points to the TCWG, ask for the meeting, in person, online, whatever mode is convenient, and accordingly do that communication. And the agenda matter is also important. So you can't just have a documentation without any agenda. Okay, so if you are seeking a meeting with TCWG, you must specify what is the agenda, whether I want to discuss planning, whether I want to discuss the audit queries, or if there are any challenges in terms of getting data from the accounts team, can also be a point for discussion with the TCWG. So every matter in terms of planning, field work, and the reporting, there has to be a communication. So frequency depends on the type and size of the company, which can be again like case to case basis. Has to be it's a judgment which you have to exercise. There is no number of frequencies like 2 years, twice or thrice, 4 times. The listed company, it happens 4 times because of the limited reviews and the annual audit. But in case of private company also, we send this communication minimum 2 times at the planning stage and at the end stage, and we seek for the meeting. Practical difficulties are there, because not every time board of directors, they understand their responsibility. They would just acknowledge, yes, we have received this email, and there is no further communication which happens. So that's something which you have to appropriately document, that we sought the meeting. There was no reply from the management, and obviously that has to be part of your documentation, because if you have recorded the video of the meeting, that also can be part of your TCWG communication documentation. Right. No, so let's say if you identified audit committees at TCWG and communicated to the board, then you have to communicate with the audit committee throughout. Yes. Yes, correct. So no, so I referred that to with reference to the private companies, because in a private company you generally don't have audit committees. So for listed company, once you identified its audit committee as a TCWG, then you don't have to separately communicate to the board. You can send them all the discussions which have happened with the audit committee to the board for information purpose. There is no such requirement, but depends if you still want to communicate any critical matter to them. But under the standard and NFRA circular requirement, the moment you have complied with the TCWG communication with audit committee, that suffices. No, so we are not asking them. Basically, we are informing them. Okay, so generally, sometimes what happens, companies come back and say, "Hey, you did not identify this issue. This entry was not wrong, or there was a misstatement on account of this particular area." So if you have communicated your materiality, that below this particular materiality figure, I'm not going to rectify anything, then there is a clarity of thought in both parties that this is not going to be touched. Okay, Because most of the times people come back and say, okay, this why this entry was not rectified. No, so you have to communicate because you will be doing quarterly reviews, you will be doing interim audits, right? So if you have ignored certain items on materiality grounds, and at the final audit, the board questions you in terms of why you ignored this particular item, so that communication is required at the beginning only. So if there is a change in the materiality at the end, you can again communicate that materiality was particular amount at the beginning, and now because of the other entries which have been passed, there is a revision, and because of the revision, we performed additional procedures for those certain financial elements, and that's how it works. Yeah. So just brief on what is FRRB and QRB. Basically, these are the two bodies set up. So FRRB is set up by ICAI mainly to ensure the audit quality and enhance the audit quality of the audit which we conduct. And there are reports which are issued by FRRB on a regular basis. So this year, FRRB and QRB both have issued the reports. It's available on their website. You can look at that full report there. What we have tried to cover is only the important key aspects here. So FRRB, as I said, it's ICI board, and they have the nominee members also from other departments and other ministries. Basically, MCA, CAB, CAG, SIs who are part of the committee. They review the financial statements in general based on the recommendations by any authority or any media reports. If you, many times you see there are media reports, so they pick up the financial statements. They don't go into the audit working papers. They basically give all compliance points from the review of only the annual reports of the financial statements. And this is just the applicability and the type of entities which gets covered for FRRB. QRB is again part of ICI CA Act only, where the central government has the power to appoint a committee, and QRB comes under central government's purview. So only difference between FRRB and QRB is that QRB comes to the audit firm. They select a particular file, audit file. So it's a specific reference with which they come, and they look at your documentation, compliance with auditing standards, as well as the accounting standards. So FRRB doesn't go into the auditing standard side, whereas QRB is a specific review of a particular client. So they generally send you the questionnaire in advance, which you have to reply, and then they come for the review. Similar to what we have in peer review. My peer review is generic in terms of based on samples which they've selected, but this is a specific reference with which they come. So so all these observations are I'll quickly cover because we don't have much time. We have in this provisions also to be covered. So what we have put here, you can refer it later in terms of what is the accounting standard and auditing standard references here. So basically, there was no actual valuation done in a particular company. So this is generally a problem where there is a startup company in the year 1 and year 2, company do not make the provision, saying that gratuity is applicable only after 5 years. But the concept of gratuity is the accrual of a cost in the year of which the services have been rendered. So even if you are going to be paid after completion of 5 years, but the accounting accrual starts from year 1, from the date of joining. So if you are doing any startup or a new company, you must ensure that the provision for gratuity is done from year 1. In fact, all employee benefit, wherever there are conditions of future payments with reference to your current services, you must make a provision from year 1. So there are similar example is there are a lot of companies who pay after completion of 5 year, 10 year, you get a 10-year bonus, okay, because you continue. Apart from gratuity, there is also a bonus for completing 5 year and 10 year. So for that also, you have to make a provision from year 1 and not on not account on the payment basis when actually is paid. Sorry. Yes, yes. So then it's not clearly driven on a gratuity act basis. It's a accrued but not due concept. So you are not actually covered under the law, but from accounting perspective, yes. Even if it is less than 10, you must make a provision for gratuity. So under both the standards, this requirement is same. So most of the observations, so basically now FRRB looks at only the Ind-AS financial statements. Earlier they used to refer the previous gap, but now they've limited their reviews only on Ind-AS. So under both the accounting standards, this requirement is applicable. So under Ind-AS, if you see, there are reserves which are disclosed under other equity. So most of the time, the disclosure which is missed out is the explanation or clarifying what is the nature of reserve. So it's not sufficient that you write only the general reserve, capital reserve, statement of P&L, amalgamation reserves. You have to give a description like this. This is a screenshot of one particular company. So each reserve has been explained as to why, what is the background of the reserve, and if there is any future utilization which will happen. So that's also mentioned over there. So this is just a snip of one particular company. So under fair value through OCI, accounting policy was not in line with the accounting standards requirement, and they missed out certain important element of how the fair value through OCI has been accounted for. So generally what practice we have done to ensure that accounting policies are consistent with the accounting standards, whether it's existing standard or the Ind-AS, we have a standard template of accounting policies. So in this particular case, what should be the wording? Okay, so for each area, whether it's a fixed asset or a FT, OCI or a FTPL, every particular element has a standard wordings which is in line with the accounting standard and actually being implemented also. So that makes life easier. So if you have a standard drafting or a standard template for accounting policy, generally you will not end up doing such errors. In case of inventory, cost formula was not mentioned. So when you draft an inventory valuation, you must mention about cost or NRV, whichever is lower, and whether that cost has been derived with weighted average cost, FIFO. So that is also important element which generally gets missed in terms of the accounting policy. So all these aspects are removed if you have a standard template for accounting policies with you. In case of PP, depreciation method was not disclosed, whether WDV, SLM. So all these points are very simple, but when it comes to the review, these points are being looked at all the regulators. So you can't escape that, okay, it's just a reference of WDV or SLM which is missed, okay? Because accounting policy is your charter in terms of how your financial statements have been prepared. So if you missed out something in the accounting policy, it is looked at the severe non-compliance because you have not complied with the gap requirement properly. So this looks simple, but when you actually read the accounting policy, sometimes you will know that some of the important elements are getting missed in the policy. Company's policy treated the R&D expenditure as revenue or capital. It did not distinguish between research phase and the development phase. So they've mentioned what is capital and what is revenue, but the standard requirement is that if it's a research, it has to be expensed out, and if it is a development expense, then only there is a question of capitalization. Okay, so that appropriate wording have to be used. Description of the provision was not given, so there was a provision under Ind-AS 37 for, let's say there was some litigation going on and you have a provision for some tax related matter. Only the amount is not enough, so you must disclose what is the brief description of that particular item and what are the timing of the future cash outflow. So you have to explain why this provision has been made, which was missing in this particular matter. classification of the employee benefit liabilities. So employee benefit liabilities, employee dues are financial liabilities. It was wrongly classified as non-financial liability because there is a contract with employee, and the standards definition of current non-current classification financial non-financial liabilities says that if there is an outflow under a contractual terms, these are financial liabilities. You have to appropriately disclose as the financial liabilities. Under Ind-AS financial statements, your current tax liability figure has to be shown separately on the face of the balance sheet and cannot be grouped under statutory dues or any other provisions. Like we have under the previous gap, we have a short-term provision which generally has this particular element. But under Ind-AS, there is a separate line item if you see the box which is given. So under current liability, there is a separate line item for current tax which has to be shown separately. Trade payable, you must have that breakup of payable to MSME and other vendors, which is again same requirement under the previous gap and under the Ind-AS. So you must have that breakup on the face of the balance sheet as well as in the notes to accounts. Yeah. So to continue with the Ind-AS financial statements, what we saw was FRRB. These are the observations from the QRB report. So there's a link given for that PDF which you can refer later. So generally Ind-AS 1, which is a presentation of financial statements, there are a lot of points which are very common. So current portion of prepaid expense was not bifurcated properly. So current non-current was not done properly. Provision for impairment in value of investments was shown as exceptional. So again, as I said earlier also, under Ind-AS there is no definition of exceptional item. So not every impairment provision is exceptional item. Okay, so again you will have to see the materiality and the amount and the circumstances in which these provisions have been created, and then only disclose the exceptional item. Policy regarding cessation of the capitalization in respect of borrowing cost was not disclosed. So when you have a borrowing cost which is capitalized for qualifying assets, there can be a delay in a project. Okay, so when there is a delay in the project, you cannot continue the capitalization of borrowing costs. You have to stop considering what is the nature of delay and the period of delay. So that policy was not mentioned in the notes to accounts. De-recognition of PPE, measurement, recognition of depreciation. So all those policy elements were missing in the notes to accounts. The last box is something which is again a common basic missing disclosure which is there in the Ind-AS financial statement is the domicile, legal form of the entity, and then who are the promoters, whether it's a parent company, it's ultimate parent company, and what are the background about the business operation of the company. So this is generally, and in fact the board meeting data also has to be disclosed under Ind-AS financial statements as a part of the background paragraph. Under inventory, the words market value, fair value, which is wrongly interchangeably used for NRV. NRV concept is different. It's not a market value or a fair value. So it's very important to understand the difference between the two, all these terms. Deposits with original maturity of more than 12 months was included in cash and cash equivalent. So when you assess the cash and cash equivalent, only the fixed deposit with the maturity of 3 months is treated as cash and cash equivalent. Not every fixed deposit is cash and cash equivalent. So you'll have to remove that particular value and show as other bank balances for disclosure purpose and for the cash flow statement purpose. Proceeds from the sale of investment was wrongly classified in financing activity instead of the investment activity, and not reporting the gross inflow and outflow of the cash from the borrowing separately. So when you have a term loans, you cannot have a net disclosure in the cash flow statements. You have to have gross inflow and outflow in the cash flow statements. Only the working capital facilities where the volumes are large, then only you have to net it off. But in case of any other loans, you have to show the gross inflows and outflows. Under Ind-AS financial statements, you also have the tax rate reconciliation. So what is your actual tax rate and what is the effective tax rate? So that reconciliation is generally missed out in the financial statements. And employee benefit, you have description of the nature of defined benefit scheme, which is not generally disclosed, and sensitivity analysis. So there is a concept of sensitivity analysis which says if your obligation increases by 1% or reduces by 1%, what is the amount of that obligation which you have to disclose in the notes to accounts. Related party disclosures. So name of the company secretary, CFO, is generally missed out because under the previous gap there is no such requirement. We disclose generally the directors and the promoters or the person who has a control over the company as related party. But under Ind AS, even CS and CFO are the related party. So you have to disclose that under the notes to accounts. Corporate guarantees and the bank guarantees are also the transaction which generally gets missed out because it's not forming part of your trial balance, but these are off balance sheet items. But because the transactions have happened with the related parties, that also has to be part of your related party disclosure. Earning per share, the moment of ESOP granted was not considered in the calculation of EPS. So if you have ESOPs, so whether these are vested, non-vested, depending on the scheme, and the potential shares which are to be issued has to be considered for the diluted EPS working, which was missed out. And there was no reconciliation given for the number of shares which were considered for diluted EPS. So if you have a basic EPS and a diluted EPS, your weighted average number of shares are different. So that reconciliation has to be given as to why this number has changed, whether it's on ESOP or any convertible shares which are there in the company. Under provisions, estimate of the financial impact, effect of the pending litigation was not disclosed. So we discussed it earlier also. So you have to disclose the probable outflow of that litigation, whether it is going to happen, not going to happen, and what are the uncertainties depending on which this provision has not been made. And not disclosing the reconciliation, not disclosing the contingent liability with respect of disputed statutory dues. So this is also one of the common thing which gets missed is you have a CARO where you mention about the disputed tax which are not paid, whereas your contingent liability has no disclosure. Okay, so it's a simple reconciliation which you have to do. If I have something disclosed in my CARO report, how can there be no disclosure under contingent liability? There will be some tax litigation which is probable. Not all tax litigation can be termed as a remote and no disclosure as contingent liability is done. But tax litigation generally gets classified as contingent liability the moment you have demands or appeal in progress. So intangible asset, again, capital commitment figure was not disclosed. Depreciation method for investment property was not disclosed. So investment property is also again another common factor or the error which happens is there is no depreciation charge to investment property because it gets classified under the investment head. Okay. So if you have taken a property for rental purpose or capital appreciation, the requirement under the standard is it should not be forming part of the PPE. It has to be part of the investment schedule. And the moment it comes under investment schedule, people miss out on the depreciation. And depreciation has to be charged for the wear and tear and the effects of time to any immovable property. So it's very important when you classify these properties as investment property and charge a depreciation for book purposes. Tax treatment can be different, but there has to be depreciation on investment property. On financial instruments disclosure, again, a lot of common things in terms of if there was a investment which was sold off and it was FE OCI, then there are reasons to be disclosed, fair value of the instrument and the date of derecognition and the cumulative gain or loss which has to be disclosed. So we have a checklist for the disclosure requirement under both Ind AS and previous gap. So even ICAI has the disclosure checklist which is in place. You can get it from the ICAI's website also. So It's a simple checklist for which covers all the disclosure requirements in the notes to accounts with respect to all accounting standards. Even operating segments, most of the times when it's concluded that there is a single operating segment, there are other disclosures which are required, which are generally missed out, which is like information about the product and services, geographical areas, and major customers. So it's not enough that you just write that there's a single operating segment. You have to disclose this additional information for that segment. Revenue from contract with customers also, what is the policy for revenue recognition regarding when the entity typically satisfies the performance obligation? As you must be knowing that the revenue recognition principles are different under Ind AS. It's a 5-step model, and under the previous GAAP there is no such concept. So basically you have to demonstrate in terms of accounting policy how your revenue is recognized. GST is sometimes included in the turnover, which is not correct. Because it's a collection on behalf of the government, it cannot form part of your revenue. So it's not an Ind AS requirements. Under the previous GAAP also, same concept is followed. And leases, so when you have a lease payment, that lease payment has to be shown separately under the financing activity, and it's not a normal operating activity expenses. So again, this cash flow disclosure gets missed most of the times. I'm not sure whether we have time. I can cover this in detail, or first I should cover the Ind AS amendments. Yeah. Yeah. Yeah, so if you have an inner column and then outer column has a net figure, should be fine. But your accounting policy still should say that the revenue is recognized net of GST. So that's not the right disclosure, but there is no restriction also to which doesn't allow. So you can have that inner column as a gross figure and the net figure outer column. 11:30, we have time. Okay. So coming back to the auditing procedures, so what we discussed earlier was on our accounting standard observations by FRRB and QRB. So as I said, QRB also looks at your auditing procedures, your audit documentation also, and these are all observations which I have covered, which are important ones. So when the SQC1 comes in the picture, it's a broader thing in terms of how your firm does the audit. Okay, so it basically lays down the policies at every level. So how your engagement are accepted, how your client is accepted, how your recruitment is happening, how your trainings are happening, who your EQC are, who is your engagement partner, do you have enough capabilities in terms of doing the audits, do you have experienced team, whether you have enough tools and infrastructure, whether you have clear understanding of the client. So this SQC1 is very important standard which governs the quality of the audit, and most of the times we have this standard template or a checklist which just gives a standard paragraph. Okay, we do this, we do this, we do this, but actually it's never been done. So SQC1 gives you the direction in terms of how your policy should be in terms of audit procedures and audit quality, maintaining the audit quality. So in this particular case, there was no documentation or comprehensive quality control policy at the firm level. Okay, so there are various aspects, as I mentioned, which has to be covered in this particular documentation. Leadership responsibilities with respect to the quality within the firm. So who is your managing partner? Okay, how does the quality gets reviewed, or what are the measures of implementing those quality aspects is something which is documented and followed also. So it's not a document only for filing purpose, it has to be followed also while doing the audit. Acceptance and continuation of the client relationship and the specific engagement. So when we have any new client reference, we just don't give the code to the client. First, it goes to the QC, so whether we want to have this client on the board or not. Okay, so whether they have enough credibility, goodwill, whether there are litigations, there are any fraud, what is the nature of their operation, are there high risk. Okay, so there is a checklist which is there, which we as a engagement partner fill up, then goes to the QC. And if QC says, okay, I'm comfortable with this client acceptance, then only the next steps are followed. So again, it's not something which is a form requirement. It is requirement by the standard. So any new client which comes, you first have to be clear in terms of client acceptance, and then the engagement acceptance. So it's very, very detailed documentation which has to be there on your file. It cannot be you cannot just say, okay, it's my friend or relative or a known person, and I'm taking this audit up. So even the recovery rate of that audit, so we have to prepare a budget, okay, and whether I have enough fees, and whether I have enough recovery rate for that particular engagement. So if I am not able to demonstrate that, that client will not be onboarded, irrespective of whoever is that person, whether it's a listed company or large company. A fee may be very high, okay, but if there's a high risk, and if it doesn't fit into the firm's quality policy, okay, that client is not onboarded. Independence is something which is very important. So every team member who is working on that engagement has to be independent. So you have to obtain these declarations annually, and it depends on the type of client. So for example, in listed companies, we take this declaration every quarter. Every time the new member gets added, whether it's audit team member or non-audit team member, whoever spends time on a particular engagement, they have to give that declaration on independence. So these are your criteria like financial interest or investments or relative working in that company. So these are all factors which have to be included in this independence declaration. Again, on XQC1, engagement performance, consultation, EQCR. So for EQCR, there is a requirement for all listed companies, you must have a EQCR. So if I am the engagement partner, there has to be another partner who will be considered as a quality reviewer partner. Okay, so this is also a stringent requirement. You would have seen NFRA orders recently. Along with the engagement partner, even EQCR is also penalized and debarred from practice. Okay, so this is not a easy job because you are not on the field all the time, and you are reviewing the work of the engagement team who are actually on the job and doing the work. So even EQCR is very important person in all the audit engagements. So it's very important to define in terms of which type of clients you should have the EQCR apart from the listed companies. So we have, for example, define the companies who will be having EQCR, like company having turnover of above 1,000 crores or 500 crores or 100 crores. So it's basically kind of a maker-checker concept we generally apply at the client's place. There was no separate engagement letter for internal financial reporting. So we have a standard statutory audit engagement letters. But if you have IFC reporting, you must have a separate engagement letter, or it has to be part of your statutory audit engagement letter. So you must define management's responsibilities and your responsibilities for this IFC reporting purposes. For impairment testing, there was not enough documentation. Typically, this is always a challenging area because most of the times clients do not understand how to prepare the working for impairment, right? They don't understand discounted cash flow method and what discounting rate or what risk weightage has to be considered and how to calculate the terminal value. So basically, if you have a working, you have to challenge that working when it comes to you. Okay, so and that is what it refers to. That if you just take the working which is given by the client is not enough documentation. So you must demonstrate or show what audit procedures you performed, how did you challenge those assumptions, because management would assume that particular growth of our revenue in next 5 years, which nobody knows is going to happen. So typically one way of doing is that do a stress test. Okay, so if this is a best case scenario, what is the worst case scenario, and what is the mid case scenario? If I change those growth parameters in terms of the revenue and the expenses, how the revised working looks like. So if I take a worst case scenario, okay, whether it triggers the impairment, and then accordingly do that documentation. On audit documentation, again, as I said, every step has to be documented. Okay, so every step. So for example, we have internal meetings with the team. So we prepare minutes of the meeting with the team. So let's say if I have a 5 team member and a partner meeting, which had a briefing discussion, so that will get documented in that particular minutes, that so and so person was present, what was discussed, what were the key areas, and what's the way forward. Okay, so every step of your audit, there has to be a documentation in terms of who has reviewed, when he has reviewed, when I completed my work. Okay, so if you have a software or a tool, it becomes easier to demonstrate who are the persons who have signed off. But if you have your physical files, okay, then it's difficult to demonstrate that thing, that when the work was completed, who has reviewed, when that person has reviewed. Okay, so you must have a checklist or a memo which should be prepared if you have a hard copy documentation. Okay, and it should summarize all the audit steps, and then person who has prepared that work paper, who has reviewed, and the engagement letter, engagement partner. So basically, you must opt in the sign-offs. And there was a recent NFRA circular which I have not covered. So basically, their expectation is the moment they call for file for review under NFRA, you must produce that file in 7 days. So a lot of firms in past couple of years sought additional time because they had hard copies documentation. So it was difficult for them to give it to the NFRA authorities. But in disguise, they were actually preparing the documentation because the NFRA has asked for the file now. So that was an unreasonable excuse which everybody was asking for, and then NFRA has come back with this particular thing that it has to be done online real-time basis, whether you have a hard copy or a soft copy. So the moment there is a inquiry or a notice, they are expecting 7 days time, you must produce the audit file. Okay, so you won't get any time to prepare any documentation the moment NFRA is there in the picture. Materiality is again very loosely documented work paper. So what was your materiality at the beginning of the audit? What was your materiality at the end of the audit? What overall materiality, performance materiality, CTM. So all those are very, very important weapons, I would say, because you are not supposed to do or rectify every error in the audit or the accounting. So you have that materiality as a threshold beyond within which you can do your perform the audit and ignore certain items. From the materiality. And once you have that item which are ignored on that assessment, you must prepare a summary of unadjusted errors also, which again management has to confirm. Okay, these are the entry which are not material and have not been rectified. Okay. So this is also a very important area where you must document your materiality and which items have been ignored on materiality in your documentation. So that's the next point which I've already covered, uncorrected misstatements which are immaterial. And under this, there is also a concept that if there is an item which is above CTM, which has not been corrected, and has been ignored because overall materiality threshold is not crossed, you must include that particular entry in your management representation letter also, because it crossed the CTM, which is the lowest level of materiality, but it is not crossing the overall materiality threshold. So that entry must be documented in the MRL also, where management acknowledges, yes, this entry is not passed. Yeah. External confirmation is another area where again not monitored properly. So firstly is how many samples have to be selected for sending the confirmations. Okay, it's not that all the vendor and customer you are supposed to select and then circulate the balance confirmations. Again, the common mistake which generally happens is you accept the confirmation which have been taken by the client directly. That's not the correct practice. So it's an auditor who is supposed to send it directly to those vendors and customers, okay, depending on the samples which they have selected, and then have that reconciliation in place. How many parties confirmations have been sent, how many have replied, how many reconciliations have happened, and those parties who are not responding, you must do a follow-up confirmation also. And if still there is no reply from those parties, you are supposed to do the alternative audit procedures. Okay, so checking the subsequent recoveries or subsequent payments is something which you must document when it comes to the external confirmations. And sometimes there are also cases which is there in the second box is management refuses to send the confirmation. Okay, maybe sometimes there could be a litigation or a dispute with respect to any transaction and they don't want you to send the confirmation. So again, it's a limitation on audit. You cannot accept that as a reason. So you have to assess the materiality and whether that confirmation is very important to be sent, and are there any alternative procedures which are possible, and accordingly you have to document. And still, if there is a challenge in terms of getting confirmation, the report must be modified. Related parties identification is always a challenge because most of the times we rely on the list which is provided by the client for related parties, but the identification is the most crucial part of the audit documentation which is not covered. Because you simply cannot rely on what management has given. Okay, so you must perform the additional procedures to identify if there are any more related parties, and then do the balance procedures. Subsequent event also is also important area where the documentation are missing. So taking a declaration from the management that there are no subsequent event is not enough. Okay, so generally there's a practice that you ask management to confirm if there are any subsequent events, adjusting or non-adjusting. But apart from that confirmation, you are also supposed to check the general ledgers. You are also supposed to check the board minutes, trial balance or the draft financial statements. Do your procedures and then rely on the management representation. Only the MRL is not enough when it comes to subsequent event. On the audit report also, most of the times, if you have seen the audit report, there is one particular paragraph of other information. So other information is basically if you have an annual report, your director report, your corporate governance reports is the other information which is also part of your annual report. So there is a SS 720 which casts a responsibility on the auditors to check those reports also with reference to the financial numbers. So whatever board has covered in their report in terms of revenue, profitability, should match with your financial statements also. So this is a common thing which is missed out because you complete the audit report and then issue the report. But before issuing our report, you are supposed to check the draft board report and draft corporate governance reports if it is part of the annual report. These are the common standard accounting standard, which is previous gap observations, which QRB has notified. Most of the observations are similar to Ind AS with respect to the disclosure of accounting policies. Cash flows generally has lot of items like exchange difference, unrealized exchange difference is not disclosed properly. There are non-cash items which are not adjusted correctly. Restriction with respect to the fixed deposit is also considered as cash and cash equivalent, whereas actually it's other bank balance and should not be part of your cash flow statements. profit and loss accounting standard 5 is basically deferred tax for the prior period items. So generally that accounting and disclosure is an error which is a common mistake which happens. And employee benefit, they are not disclosing the description of the nature of benefit and the current service cost, past service cost in the notes to account. So there is an exemption which is given to the SMC companies. But apart from the SMC companies, non-SMC have to give all the disclosure in the notes accounts. And when you have an operating lease, which is like a 3-year contract, for example, and there is a non-cancelable contract, the lease has to be amortized over a period of 3 years. You cannot account the actual payment on a year or 2-year basis. You have to account for that lease on a straight line basis. So these are recent amendment in days, and I would cover that in this slide. So there is no recognition or measurement related changes which have happened in the Ind AS. So basically all the changes which have happened are with respect to the classification of the liabilities, especially the loan liabilities, into financial and non-financial, and the current and non-financial, current and non-current classification basically. So the only thing is, the Ind AS, there are amendments with respect to this, but under the previous gap, there is no corresponding amendment similar to what these changes have been made with respect to the classification. So under Ind AS, current and non-current classification has been prescribed, whereas for the previous gap, the classification criteria is given in the Schedule 3, not in the accounting standard. So currently, if you are doing the audits for both the gaps, your classification criteria will be different for this financial year till the time they make amendments in the previous gap or the previous gap Schedule 3 also. So basically, what they are saying is, let's say I'll summarize this with a simple example which will be easy to understand. So if you have a loan, which is a long-term loan, let's say taken in 2023, and there was a debt equity ratio covenant, okay, which was to be complied with, and in March 26th, that debt equity ratio is not complied with. So there is a default or the breach of covenant, okay. So till previous year, what used to happen is, let's say in April month, you went to the bank and regularized that covenant, and then bank approved that particular thing. You continue that non-current classification because it was a long-term loan, and then classification continued to be a non-current. But with this amendment, what will happen is, even though the subsequent changes have been accepted by the bank, which is in the month of April 26, because the bank had a right to recall that loan because the covenants were not complied with, that loan will get classified as current under Ind AS financial statements. So this is very important. So all these right to defer the settlement, rollover liabilities, liabilities with covenant, convertible debt. So this common factor which is there, that subsequent event, if there is a regularization or a covenant acceptance by the bank, will not be considered for classification as of 31st March. So as of 31st March, if you have defaulted into any covenants and if you don't have a right to defer that settlement, your long-term non-current classification will be current for 31st March under Ind AS financial statements, where under previous gap, there is no such requirement and you can still consider the subsequent events and continue your non-current classification. So that's something which is very important to note, because a lot of large companies or the loans may have this compliance burden and the covenants, which during there was a default, but the companies go to the bank after the year end to submit the letter and regularize those things. So this will change their classification. And on third point, which is a supplier financing arrangement. So there are arrangements with the banks and suppliers where the supplier gets the payment from the bank, okay, before the due date of the transaction, and the company bears the interest on that arrangement. So supplier gets the full payment, whereas it's treated as a financing arrangement for the company, and the interest comes in the books of the company. till now, from disclosure perspective, there was no specific requirement to show these arrangements in the financial statements. The common disclosure which every company used to make was disclosed as part of trade payable, because vendor, it's still your vendor liability, which is being paid through a financing arrangement. So people used to avoid this disclosure because it will impact their banking norms, okay, because it will otherwise go as a trade payable. So what Indias has done is has asked for the detailed disclosures with respect of this financing arrangement with respect to the vendor. So they have not asked to change the grouping or the classification, whether you classify as a borrowing or a trade payable. What they've asked is a detailed disclosure with respect to this financing arrangements with vendors. So you have to give the opening balance, closing balance, how much has been paid to the vendors, how many transactions have been completed or closed with that vendor, and the terms and conditions of this financing arrangement. So this is an additional disclosure which will be there in the India's financial statements. So all these amendments are effective April 1, 25. So those will be relevant for March 26 financial statements. And the last one, the last one is Pillar 2 legislation, which is still not effective from tax perspective. So there are deferred tax implications which are there, which currently not relevant from audit perspective for this year. Yeah, so that's it. Covered all the items. If there are any questions, happy to take that.
Any questions from members? Though there were many questions which were asked during the session only, but if in case anyone wants to have a clarification or any sort of doubts which are coming to mind, can be asked to the speaker.
Yeah.
Yes, please, sir.
Yeah. Yeah, so materiality concept is there in all the gaps. So it's not only the India which we apply this materiality concept. So unless you do the working, you will not come to know whether it is material or not. And again, it's a group reporting perspective which will be relevant for, and for them, how much India operations are material at a overall level, because they define the audit scope, right? So if they have covered that audit scope as a full-fledged audit or a limited review, and this element can be there because those provisions are still not notified. So that impact has to be considered at the group level rather than India level. But if the working which is possible, obviously that will help to do that materiality threshold work calculation. Yeah, so on tax side, I will not be able to answer. If something is on audit, I can answer. Thank you.
I think so. There are no more further questions. So Samir bhai, please,
Yeah.
you can just come.
Thank you.
So thank you, Samir bhai, for enlightening the members. So I would now request Shreyan Stadia to offer a hearty vote of thanks to the speaker.
Good morning, members. So audit being more stringent day by day, thank you CA Samir Parmar for such a engaging seminar, an enlightening seminar with a detailed presentation and practical examples. We have covered recent changes in labor code NFRA circulars, and other observations by other governing bodies affecting the audit process. It will help all the members to be well equipped for the coming audit season. Requesting all the members to present a huge round of applause for our today's learned speaker.
We welcome our second speaker, CS Anup Deshpande, and we will have a short break for 10 minutes and we will get back on the second session.